On Thursday, Nifty rallied almost 500 points from the lows, but here is the real question. Was that genuine bullish acceptance, or was it just short covering without value shifting higher? Welcome back to Mind Monastery. Today's session was extremely educational because price moved very strongly upward, but the volume profile told a more subtle story. And that difference matters because if you understand whether a move is driven by real buying or by short covering, you will stop misreading strong rallies. Now, what happened on 2nd April 2026? Let's break down the market phase by phase. The session began weak. The market opened lower and the point of control initially developed around 22,400 area and then shifted further down towards 22,320 area. That tells us that in the first part of the session, the market was still accepting lower prices. In other words, sellers were initially in control. Then something important happened. After shifting lower, the market stopped continuing downward. The lower prices were explored, but the market could not build further downside continuation. This is often the first clue that the sellers are no longer comfortably pressing the auction lower. And that is where the next phase began. From that lower zone, price began a very sharp upward rally. Now, on the surface, this looked very bullish, but if we examine the volume profile carefully, we notice something very important. Even though price rallied strongly, the POC did not migrate upward with price. It remained lower, and that changes the interpretation completely. Now, this is the key educational point from today's session. That is, short covering versus real buying. There are two different types of rallies in markets. The first is a value-driven rally. In that kind of move, price goes up, value shifts up, and POC migrates higher. That is genuine acceptance. The second is an inventory-driven rally, or what we commonly call short covering. In that type of move, price rises quickly, but value does not shift with it, and the POC stays behind. That is exactly what we saw. Now, are such rallies common in markets? I mean the rally that you saw on Thursday. Yes, they are very common in markets, and it usually happens when monthly options or futures auctions begin. If you are interested in learning more about the starting of a monthly auction and changes that it brings to the market, type yes in the comment section below this video. Now let's continue further. Why price moved so much without POC shifting? So how can price move nearly 500 points while POC stays lower? Because price and value do not always move together. Price can move very quickly when traders who are short begin exiting their position. That creates forced buying. But unless the market spends time and volume at those higher prices, value does not shift. So what happened was this. Lower prices were accepted first, then sellers got trapped, then shorts started covering, price moved sharply upward. But the market did not spend enough time building fresh value higher. This is why the PSC remained lower. So the correct reading for this session is not simply a bullish trend day. It is more precise to say this was a short covering rally from lower value, not yet a fully confirmed higher value acceptance day. That distinction is very important because if you mistake short covering for genuine buyer conviction, you may chase the move too late. What should you learn from this? The lesson from this day is very powerful. Not every strong rally is real buying. Sometimes the market rises because sellers are forced to exit, not because buyers are confidently accepting higher prices. And the easiest way to distinguish the two is this. If price rises and POC also rises, that is stronger confirmation. If price rises but POC stays behind, then be careful. The move may be driven more by short covering rather than by real acceptance. Let us add up some trade management insights to this. For a trader, this kind of session means that it should be handled differently. If you recognized the early exhaustion at the lows and the sharp upward momentum, you could participate in the rally. Now, to identify the early exhaustion at the lows, you can use the order flows. Of course, we will discuss about these concepts also in coming videos. But because value did not shift upward, this was not the kind of the day to blindly hold late longs, expecting endless continuation. This was a day to enter early if you understood the shift, I mean the exhaustion, trail more actively, and watch carefully whether higher prices were actually being accepted. Now, let's look at the key levels for Monday. The first key zone is the 22,320 to 22,400 area, which is where value developed at the lower part of Thursday's session. This is the most important support zone and the reference zone. Then we have the 22,750 to 22,800 region, which is where price was holding near the end of the session. This becomes the immediate short-term control area. Above that, the next important resistance zone is around 22,865 to 22,900. This is a major reference level from the earlier structure. So for Monday, here is the framework. If the market holds above the upper zone and begins building time there, then the rally may evolve from short covering into a real higher acceptance. But if the market falls back and starts rotating towards the lower value zone, then Thursday's rally may be read as primarily a short covering event rather than a full bullish shift. So the real question for Monday is not just will price go up or down. The real question is, will value shift finally upward? This is the confirmation we need. If higher prices get accepted, the market becomes stronger, and if higher prices are not accepted, then Thursday rally remains incomplete. If you found this analysis helpful, subscribe to Mind Monastery, because here we do not just look at candles, we study price, value, acceptance, failure, and the real auction process behind the market. Thank you and happy trading.